So should you try to time the stock market? That's a question that we often get from investors, and maybe you're asking yourself the same question. After all, it's only natural to want to get in and out of the market at the right time to help enhance your long-term wealth. Today, I'm going to walk you through that. My name is Mark Fonville. I'm the CEO of Covenant Wealth Advisors. We're a personal financial planning and investment management firm located in Richmond, Virginia, and we tend to help individuals age 50 plus with over $1 million in investment assets plan, invest, and reduce taxes in retirement. So let's dive into the slide over the next couple of minutes. So here's the question. Should you try to time the stock market? Well, in our experience, we've seen that most people are really poor at trying to get in and out of the market at the right time. I mean, think about it. If you've ever told yourself, I want to wait until the market, or I want to wait until I feel good about the stock market before I invest. So the market goes up, you put more money in, inevitably the market gets hit again, it goes down, and you regret what you did. Maybe the stock market actually drops 10, 15, 20%, and then you get nervous and maybe you pull out. Well, that cycle clearly is not a winning cycle long term. After all, don't we want to buy low, sell high? But the truth is that emotions don't allow us to do that. So when do the best days in the market actually occur? Well, what we've seen by history is that the best days tend to often happen after the worst days in the market. But if you're not in the market to actually capture those great returns, it can really hurt your long-term performance. So what we're looking at in front of you is the investment of $1,000 in the S&P 500, a popular stock market index, excluding fees, starting 25 years ago. And each bar represents either investing for the full amount of time, never pulling your money out, and then simply missing a certain number of days depending upon the column that we're looking at. So for starters, let's say you invested $1,000 25 years ago. That $1,000 would have grown to $3,174. However, let's say that during that time frame you became nervous because the market dropped off. Because you got out of the market, you end up missing just one of the best days in the market, or actually missing the best day in the stock market over the past 25 years. That actually drops your portfolio value to $2,845. But let's say you actually miss more than the best day. Let's say you missed the best 5 days in the stock market over the past 25 years. Well, what does that do? That means your growth from $1,000 only goes to $2,006. If you miss the best 20 days, you've actually lost money now. Your $1,000 drops to $857. You miss the best 40 days, your $1,000 actually drops to $366. So what we're trying to illustrate here is that timing the market is really difficult. The best days often happen after the worst days, but if you're already out of the stock market, the likelihood that you miss the best days is very high. And as you can see, your returns actually decrease depending upon the number of best days that you miss. So what we've found long-term is that if you have the right investment plan in place, the right portfolio in place with the right amount of risk that's aligned with your goals, you should have something that you can tolerate those ups and downs. And when you do that, you're much more likely to stay invested over time. And as you can see, staying fully invested in this scenario shows the best results. So with that, I hope you found this helpful. If you like our videos, be sure to follow us on YouTube, and we'll see you next time. Thanks so much.